Welcome to video lesson 3.4. Thank you for joining us this lesson. This is a very special lesson. Every previous lesson has been working up to what you are about to experience in this particular lesson. So, what we're about to talk about today are the M and W multifractal reversal patterns. So, everything that you've learned in previous lessons, for example, stop hunts, trap zones, whipsaw formations, spotting the highs and the lows, all of these things, all of these structures will be used in conjunction with this main topic that we are going to be speaking about today. So right now in this video lesson we are going to go over the M and W multifractals that are used when entering a trade, and this is a trade that works off of a fundamental programming of the retail herd. So if you read the video, or I'm sorry, the lesson, if you read what you had to read in the lesson on our site Forexia Pro, you saw this structure here. Now this can be found by going on Google and typing in structure of a story or the structure of drama, just an example, and you will find structures like this. And basically we have pointed out or linked these two structures together, these two formations in the market, and why they happen. So they happen to induce drama and trauma. They induce states of trauma in the retail traders as soon as they commit their funds into the market, and the emotions go through these cycles, these structures. So just imagine to yourself how it would feel if you were in a buy position at this particular, anywhere in this area you bought, and let's see how many days, about 2 weeks. So let's say in the span of about 9 days, so about 2 trading weeks, in 2 weeks you had about 129 pips of profit at the peak. At the peak you had about 130 pips of profit. What is the retail trader thinking? The buyer and not even the buyer here, not even this buyer, but all of these buyers that bought anywhere in this area, or even here, these poor guys, what are they experiencing? What are they thinking when smart money is seizing the prize? What do they think when this massive move happens? This candlestick happened in less than 1 minute. In 1 minute, there was a hundreds and hundreds of pips were lost on the GBP. About a 300 pip drop, a 220 pip drop in 1 minute, and then a 300 pip drop in about 9 hours. A total of 9 hours, 300 pips. That obviously creates a state of trauma in the market participants that are buyers, that are buying, and that scares any buyers out of their position right before continuing their move upwards. So you can see there's that massive move, that massive spike down to get the buyers very emotional, in an emotional trauma state. And then you can see once the buyers are punished, that's when the market goes up. So these large volatile moves like this are not to be trusted. They are not to be trusted. So why this trade? Why this trade? We've went over how it works off of a fundamental programming of the retail trader and induces trauma. It is a multifractal pattern. It is meaning that this trade can happen, or this pattern, this formation occurs on all time frames and on all pairs. So you can go on the 4-hour chart or the daily chart and see these same patterns occurring and trade them, and they will have the same characteristics, but only on a larger time frame, a larger span of time. So we're going to focus on the 15-minute chart and trading intraday. So holding trades for a few hundred pips, for a few hours or a few days, not just a few minutes or 3 or 5 months. We're not holding trades for that long or that short. We're holding them for what I think is a optimal amount of time to get an optimal amount of pips. So we will be catching trades that, for example, happen like this. This is a very perfect example of what you see here. Very good example. So the multifractal patterns have little to no drawdown. Once you confirm your high or your low and you're going with the trend, well, it really doesn't matter if you're going with the trend or against the trend. if you catch the high or the low and you actually catch the trade, for example, right here, you could have identified GBP USD created this high and placed limit orders here, and on a smaller time frame, on a 1 minute chart, we're not going to go down to the 1 minute chart, but on a 1 minute chart you'll see this is a small M formation right here. You could have taken that off of the high as a sell and then waited a day and a half and caught those 300 pips. So with very little drawdown. For 5 pips for a 300 pip drop. If you waited a bit longer, let's say 12 days, that's almost a 400 pip drop. But you caught the initial drop and you didn't have to wait through this consolidation phase. So you caught this initial drop and you could have cut out. You could have taken your profits right there and then seen this low was formed after that volatile drop. That violent volatile drop created this low, and then we can see the price created that W formation off of that low, and we could have gone long here instead of sitting through days of going short, thinking we're in the right direction, we're going to keep going short and swing trading it, and ending up with 3 weeks of consolidation, and then in one candle we are stopped out at break even, or 2 candles. So these are very, very good structures to trade if you like to trade fast movements and make fast profits without being in the market for a extremely long amount of time. Huge profit margins. So as we've talked about, as we have seen, the risk-reward ratios are absolutely massive. I could show you this here. This was when I was first learning how to trade the M's and the W's, when I basically first taught myself how to trade them. This was one of my first days teaching myself how to trade this pattern after finding this. And this is what I was able to do. These were the risk-reward ratios that were coming out of these trades. 1 to 19, 1 to 20, 1 to 21. The entry accuracy, 95%. Some of them 100%. These are incredible, incredible trades. Profitable, time profitable, 90 to 100%. Incredible. Very, very little drawdown. So this is the possibility with these trades, you guys. These are the possibilities. And on a higher time frame, if you would like to trade these on a macro time frame, these are multifractal patterns, so they do occur on a higher time frame. If you are that type of person that does like to swing trade, you can go ahead and trade these patterns on a higher time frame as well. So, it appears my internet or trading view is lagging a bit. Well, I'll just keep talking about this because I don't want to drag the video on very long. Simple zero indicators. You can trade these M and W formations with zero indicators. I've been doing this for a very long time, trading with zero indicators. I did start with just using one indicator, actually two EMAs and TDI or RSI. They both helped me a bit, but I grew out of them. Once I saw that they were just tools, and that price action is really what the market is. Like, you're seeing the market itself. That's when I realized that these indicators are just working off of price. If I see price and understand price, then price is king. Price action is king. So I'm not sure what my charts are doing right now on me evolving into something. I'm sorry about this, but until they come back, until they start to load back, I guess they are loading. I do have internet. I'm not sure what's going on. But, alright, here we go. We're back. Good. Thank goodness. Alright. Why this trade? We went over why this trade is an amazing trade. Now, some of the rules. Go with the trend. Going with the trend, you will pick up more pips, obviously, and going with the trend is just more, it's more reliable, especially when you're a beginner. When you're a beginner trader, going with the trend is just the obvious thing to do. You can really just, you don't even have to have a strategy if you go with the trend. You can buy with a very large account, and if you're going with trend, you can make some money. So, only trading London or New York session. This is also a beginner rule. These trades do occur Asian session as well. They occur all sessions, but we're going to primarily focus on only London and New York session because this is the most volatile sessions. These are the most active sessions. So, rule number 3, wait for the stop hunt. The second leg to the high. So, let's take GBP USD for example. Let's say you are trading GBP USD and you have these trend lines graphed out. It's jumping up and down in this trend. First of all, what are retail traders? What are retail traders going to see? A retail trader is going to see this trend as an uptrend, and then graph multiple support and resistance lines along these on this chart. Let's say, for example, there is millions and millions of retail traders graphing this same support and resistance area right here. Now, the chart we can see on the 15-minute chart is an obvious uptrend. So we would assume that the retail traders, the retail herd, would be trading and placing buy limit orders in this area, anywhere in here, anywhere above this support or resistance, anywhere above here, anywhere above this high. Because how many traders do you know that trade breakouts? This would be an obvious breakout of this high, and the retail trader would take that as a buy scenario once upon seeing that candle break out to the high. So what happens? This is basically the fundamental characteristics of this certain trade, this structure, this pattern. This is the key to this pattern. What I'm telling you right now is what you should relay in your mind. Where is the liquidity? Visualize the liquidity. See the liquidity happening. Now, it just so happens that we have a wedge formation right here that occurred, and the breakout of that wedge formed our signature trade, which is that M formation here. And you can see this bar, understanding this bar was once fully green. This was once fully green all the way up to here. There are buyers now trapped all in this area. All this liquidity was trapped in this area, and now what must the dealer do? What does the smart money have to do to take out the retail trading herd? All he has to do is drag price against them. And you can see that he drags it once against them, a sharp move, a shift out of the zone, and then comes up one more time for more liquidity, more volume, more money, and then slowly comes down, slowly shifts the zone, and then once he is at the low of the day, retail traders think, okay, here is a support. I'm going to get lucky, and I'm going to hold my trade, and not stop myself out. And what happens? Boom. This causes retail traders to panic and they stop themselves out. And then that's when the market finally goes in the direction that it was intended to go. So don't trust these volatile moves. Don't trust these stop hunts. When we went through the rules, one of the rules were wait for the stop hunt. This is the stop hunt. This large candle. Once it closes below the high, the previous high, so you could say right here or right here. You could take either of those two highs. This is the candle close high and this is the wick high. You could take either of those two highs and use them as confirming entries. So, for example, once the candle closes below either of these two highs, whoops, I'm sorry about that. Once price closes below either of those two highs, you will be able to take that as a confirmation to go short. I'm sorry about that confusion right there. Alright, so once again, once price closes below the high in a confirmation candlestick, after seeing that stop hunt to the high, now you could have entered here as well, right here. After this, seeing this, you could have said, well, that may have been a stop hunt. But you would have wanted to wait for this next candle to close until you enter your sell, especially when going against the trend. Because when you're going against the trend, you want all the odds in your favor, or at least as many odds as you can get in your favor. So visualizing that liquidity that is there and questioning, why did that happen? Why is that stop hunt happening? Obviously, there's liquidity that is now trapped in this area, and what happens after that? The dealer needs to drag price in the opposite direction. So, visualizing the liquidity is optional. It's just something that helps me out. It could help you out as well. Stop hunt second leg M or W to the high or low or past the high. We can see here the stop hunt of the second leg broke out to the high and actually surpassed this high, but the characteristics of an uptrend are creating higher highs. The higher high was created, but upon creating that higher high, that trap was also triggered and the liquidity was gathered and needed to be disposed of. So the retail traders, buyers that were trapped here, needed their stop losses to be hit upon being trapped here. So here, once again, we can see that higher high was created. Here's the previous high right here, that wick, the high of the previous day, and then we can see Asian session consolidation until London session, and then London session. Here we can see this was 8 hours of consolidation until 10:11. So this would be about 1 o'clock in the morning. So that's right around London session opening for me. Right at the opening of London session, there was that breakout to the high and then that smaller M formation that was created on a micro time frame. So you could go on a smaller time frame and check that out. You could have sold upon seeing these confirmation candles, these railroad tracks. 1, 2, 3 of them we had before that shift out of the zone, and then that initial drop. And then you can see once again we have the price rejecting or respecting this trend line to get retail traders that are selling to take their profits. And then what you see here is a smaller M was created here, and then at exactly session changeover, this blue line here, the creation of a new day, at exactly that time, GBP USD dropped 200 plus pips in 1 minute. Why this time? Why at exactly this time? Because if you've checked your MetaTrader at that time, or whatever you use to trade, if you've checked your spread of your broker at that time, all the brokers are manipulating the spread at this exact time. So it's a universal time that the brokers have configured to manipulate the spread. So the spread could have been manipulated up to 50 pips upon dropping, and then we can see if it was a 50 pip spread, all the orders in this area could have been sucked up, and then price doesn't come down to that area until later. So these are basically the stop hunt to the high is a characteristic that, or I should say the high or the low. In this case, if you were going with the trend, you could have taken this W formation right here. You could have seen this violent breakout to the low, and then that W formation. The low was not broken, and then you can see all these wicks and also the confirmation candles, the confirming entries, the railroad tracks. All these are possible entries for buys if you want to go with the trend. And then until you see the next sell opportunity within your range of these trend lines. But don't get caught up in these trend lines because they're not your friend, right? They weren't created to help you. They were created for retail traders to help retail traders understand the market and help them think it's easy. So, moving on to the next confirming entry. So, the second leg of the M or W has to be a confirming entry. If it breaks the high or the low, if it's a W formation, it has to break it and then create a confirming entry candlestick. So, in other words, the previous day, the high was broken here, but it was broken in a wick and price came down and closed in a railroad track formation below the previous day's low. So you could have taken that as a confirmation to sell and then gotten your 30 to 50 pips as you are going against the trend here. So 50 pips exactly. Exactly 60 pips about. But you could have easily caught 50 pips of that trade and then went with the trend and stopped yourself out upon seeing the smart money working the high London session. So you could have then taken a sell position here and gotten those pips. Alright, news-induced stop hunt or wedge. Alright, this was a wedge-induced stop hunt where our signature trade, I should say, came and created the wedge, and then the breakout of the wedge was the second leg of the M formation, and vice versa with the W formation. Same characteristics. So, news-induced stop hunt. There will be times where, just like this, a wedge will form, or a high will form, a first leg of a M or W will form, and then a news event will be released, creating a stop hunt to the high or the low, finishing the M or W formation. I would say about 7 or 8 times out of 10, a news event will spike to the high or the low of the day or the previous day, or the high or the low of the week, the month, etc. So, our signature trade, we went over that, the wedge formation, creating the stop hunt, divergence on the TDI or RSI. Now this is optional. This is for beginners. You can use this if you are a beginner. This does help sometimes. Sometimes it doesn't. It's all personal preference, I guess. Here is both RSI and TDI. You can go into your indicators and type in TDI, and this is the one we are using, or RSI, and this is the one that we are using as well. So this is the RSI, Relative Strength Index, and this is the TDI, Traders Dynamic Index. So what is divergence? What would we be looking for? What divergence is price saying one thing and then the indicator saying another thing. So for example, price here created this low and we can see price is downtrending after creating that low on the TDI, but yet the TDI is uptrending. So this is what we call divergence. This is what is known as divergence. When price is going one direction and the indicator is going another direction. And this helps understand if the M or W is valid or not. So let's say we take this W formation and we want to know if this is the low. This is the low of the the previous day, and we want to know if the indicator has a chance, shows us that there's a chance of this being the low and that it will create an uptrend or start uptrending like the indicator is indicating. So we can see this W formation to the low of the day here. This is right at the beginning of New York session. This may be right at the ending of Asian session. Or excuse me, London session or the ending of Asian session. So what we see is this downtrending, and yet this is uptrending. What we can confirm as a buy is our confirming entry railroad tracks to the low of the day. We have divergence on the TDI or the RSI, whatever you want to be using. You can use both if you want. I don't even use either. I have come to the point where these are just tools, you guys, and you will evolve to the point where you don't really need these tools because these tools are just working off of what price is telling us, and price is king, like I said before. So divergence is optional. It does help, though. You can see the uptrend, and then on TDI we can see the downtrending happening. So the TDI often tells the truth. Sometimes it will lie. I'm not going to lie. it does lie to you sometimes. It will lie, and that's why I don't use it very often. So here is an intraday, basically I would say out of the week, there are 5 days in the trading week. I would say 1 or 2 of the 5 days consists in this pattern. So we can see it here. We can see it here. Different variations of it, but it's the same pattern. I would say 1 or 2, if not 3 or more days occur like this. This happens, this is needed to, number 1, take out the buyers and the sellers, and number 2, create the highs and the lows of the day and the trend. So the trend can be marked out by these retail traders. What we can do is trade these formations that occur on, so let's say this happens once every 1 or 2 days on per pair, but we have how many pairs to work with. So in other words, every London and New York session, this breakout to the high and low is happening on every pair, or just about every pair. It is a very, very, very high chance that it is happening on any given pair. So we have a very large range of pairs to work with. Or you can just work with one pair however you want. But I tend to focus on an array of pairs to trade with. So we can see Asian session consolidation, London session breakout to the low, and then that W formation, and then in one candlestick we can see that may have been a news-induced, probably a news-induced spike getting out of this range. So this zone was completely cleared out in one candle formation. And then we can see the high of the day. This was the high of the day. The high of the day was breached in this one candle formation and created a new high of the day and then worked off of this high. You could have sold any one of these candlesticks and then, gotten out here. But I don't know why you would do that if you were going and you already got this move. So I do believe this was a news-induced second leg. But yeah, that was just going with the trend, with the uptrend. Very, very, very good formation. Very good daily structure here. Here we can see it happen once again. A very, very nice structure. And we actually caught this structure. This was our signature trade as well. Second leg breakout to the low of the previous day. And then you can see the trap here. That shift out of the zone in just a few candles. And then we actually rode this up about 400 pips up to here. I don't know why I'm using that box. Yeah, we rode the price up to where it is right now. So we are still holding. And that is over 600 pips profit. And drawdown was, we had our limit orders right in here. I'd say drawdown was about 16, let's say 20 pips. 20 pips drawdown for 600 pip trade. Very, very nice play out. And we can also see this probably had divergence as well. Yep. Downtrending on price, but yet divergence tells another story. Right? So, just another tool you can use, you guys. Now, being very selective with your trades. This is a very important one. If you don't feel as if the trade is playing out the way you want it, or the M doesn't look like an M, or you're questioning it, you're questioning the stop hunt, you're questioning the confirming entry, then don't do it. Go to the next trade. There's always going to be a next trade, a next pair, a next setup. So take your confidence back, you guys. With these trades, you'll be able to gain confidence. You'll be able to over leverage, but in grasp in, you'll be able to have these trades in your pocket, in your back pocket, that you can use to your advantage, and they're a massive advantage. So one of the last things that I wanted to mention was the second leg of the M or the W formation. Now, we can see some of these. If you would have placed your buy limit order at the low here, it took about, let's say, 2 hours before you were shifted into profit. 2, maybe 3 hours. Now you're waiting there, and you're waiting for it to go into profit, right? If the price has broke the low and price is not making any of the confirming entry candlesticks, and it has broken the low for more than an hour and a half, and it is working the low or the high for more than an hour and a half, and you entered at the exact high or low, cut your loss. Cut your loss, because the smart money is going to keep working the high or the low, and it is no longer an ideal setup. Move on to the next setup. You want to be in these trades for a very small amount of time. Now, this doesn't apply for the macro time frame, for trades that are on the 4-hour chart, but it does occur, and it is a rule for the 15-minute time frame. So for example, here is an M formation. Here is the high that was created, and this was a valid M formation. It worked the high for 30 minutes and then dropped. That was perfect. See, these trades don't like to stay in the up at the high or the low for a very long amount of time, because the dealer, smart money, will lose the liquidity that he has trapped at the previous high or low. So take that into consideration when trading these setups. Don't be in at the high or the low for more than 2 hours. Stop yourself out. Cut your loss at break even, or at -5, -10, -3 pips. Cut your loss. You don't want to go into massive drawdown. That's not the point of these trades. The point of these trades is to get the best reward for your risk. So the best risk-reward ratio setups. Alright. Thank you guys for watching this lesson. I'm sure it was a very long lesson. I'm not even sure how long I've been speaking for. But if you are still watching until the end, congratulations. Pat yourself on the back. Thank you. You are a very dedicated person. Thank you for taking the time to learn this skill. It will help you. It will. This is revolutionary, you guys. This is something that once you understand, it will click, and you will no longer be the dumb money riding trades in hundreds of pips of drawdown, or trading with drawdown. Drawdown will become a thing of the past. So thank you guys once again. Until the next video lesson, peace out.